Hello everybody, it's Greg from Ragosa here. Welcome to the channel. Thank you for joining us. If it's your first time here, glad to have you. If you're returning, it's nice to see you again. I hope to earn your like and subscription today. Today here is the Friday after the August WASDE, and what a Friday it was. We saw what I would call rather light volume on the December futures, and we saw a lot of action coming in right at the close. So there's a lot of cool stuff, happening. I just want to lay down for anybody that might be seeing this video for the first time in the series. What we're looking at doing is trading the 2026 corn harvest. We're going to do that through a poor man's covered call. Essentially, we are creating a synthetic corn farm within our portfolio. So if you are, a trader, retail trader, quantitative trader, whatever, we're building this using the derivatives and taking what we know from, the equity markets space, and we're applying it to commodities. And we're working with some of the nuances that commodities have. If you're a farmer, then you know what? This is a really cash efficient way of slamming an extra 28 acres per lot into your business operations. I mean, you don't have to worry about planting risks. You don't have to worry about localized weather risks or anything like that. All of that is completely diversified across the entire U.S. corn production. And you're just trading straight off the Chicago Mercantile Exchange, straight off the big board, and creating a farm like that. We are also in this process warehousing or taking on the risk that you get for transferring. Like, so when a farmer wants to go and buy some farm insurance, crop insurance or something like that, they can either go and purchase put options straight from the CME, or they can engage with their bank and do a risk transfer. What is this called? An exchange for risk, an EFR, and that actually pops up in some. We'll get to that. Pops up in some of the contract volumes that pop in there. So anyhow, that's kind of what that is. There's a couple ways you can play this. You can go and create markets by selling the puts and getting long exposure that way, but the convexity or the skew in commodities trading happens to the upside. It happens on the call side. When stress hits the corn market, prices are going to increase unless there are some kind of bottlenecks, logistics bottlenecks, and that's what we're going to focus on. Now, just as a bit of a teaser, you can create little synthetic operations in other aspects of your portfolio as well too. So like, you can create a little synthetic gold mine, or you can create a little synthetic oil operation. And maybe I'll make some videos on that as they come through over the winter or whatever. I don't know. But anyhow, that's what we're doing here. And today we are focusing on corn. So sit back and let's have some fun. Let's just look at what happened here in our December. So really, when we look down on what happened overnight, this is here, maybe the 15-minute chart. It's the 15. Yeah, 15 shows overnight data. Once Asia picked up, there was persistent kind of macro corn buying, and perhaps why was this the case? Let's look over here. It could possibly be because of the Shandong, sorry if I mispronounced that, crushing margin. That is used for crushing beans, and so they're losing money crushing beans, and they may be looking to crush some corn instead. So they may be wanting to pick up some of that on corn, or they maybe have been buying the dip a bit that came in after the day after the WASDE. Hard to know. It could be some, global macro funds running some interest rate changes. There's some instability right now happening in Japan and with the yen. So, there could be some cross asset plays in that aspect as well too. It's hard to know, and that's not what we're looking to focus on. What we really want to know though is we're looking at the relative volume that was coming through overnight. Overnight it was pretty small, and you can see it just kind of ground higher, stairs, and then sold off a little bit, and then went higher, and then exploded right at the end of the day. And so we're going to talk about that a little bit. But looking at the daily here, this is about 7,500 contracts traded right at open on the day. And then we just didn't see much volume thereafter. Corn did move up a little bit, but there wasn't a lot of volume that moved through, except for right at the end, where it was probably close to 12,000 contracts at around what time is this here? At around 1:10 Chicago time. And then at 1:15, it pushed maybe 8,000 contracts. So, let's call it 20,000 contracts in the last 10 minutes. Really, really, really rapid. Kind of what we saw yesterday as well too. And so we'll look across the chain and decode that. Just quick looking at my notes here. Okay. Yeah. All right. So that's what was happening here on the December contracts. We can pull up just before we get to the December here. Let's wait for that to log up again. Yeah. So 152,000 contracts were traded on the public exchange tape. Overall volume for the December contract was 225,000. So we're seeing some exchange for physical, and perhaps some exchange for risk. And I cannot recall if the TAS, the transaction at settlement, also, no, transaction at settlement does not hit that. So that is going to be that should be, or at least it shouldn't be. If I'm wrong on that, somebody call me out. But from what I understand, the TAS stays on the market maker's books until the very end, and then the market makers need to zero that out, so they just fire it all through. So even if the TAS shows different volume, that volume is still going to end up on the books because they have to zero risk at the end of the day. Yeah, but if one of you guys knows better, correct me, please. In September, we saw the same. They had a little bit more juice here, or in terms of volume come through, and unfortunately, the overall volume on September did not. Why are you not? When I was making the notes here, there was more volume that showed overall on the day in September than the 53.9 thousand, basically 54,000 contracts. I want to say it was like 20,000 more contracts. So it was like around 70 that were traded on the day here in September. But we can see here in the last 10 minutes, we got 5,000 contracts, then 3,000. So a total of 8,000 contracts, give or take, were traded in the last 10 minutes. So a big bump. And then let's look over at March. Was it the same deal in March? and it really was. Although we got some selling off instead, so March actually ticked down a little bit in that last 5-minute session, but still had 2 huge volume nodes pop through. Overall volume on the day was 18.7 thousand contracts, 18,700 contracts on public tape, and 46,400 contracts that did not hit the public tape. So that would be the exchange for physical or the exchange for risk. And that seems pretty significant to me here. Pretty significant. Why is that significant in my mind? Because if you're able to see it, you might not be able to see it because it's a little bit too small. Maybe because I have like so many screens set up. Or maybe but there is September was trading for basically 459. December is 484, and March is 499. So there is a lower spread between all of those months. All of those months should be having an 18-point spread to account for the cost of carry, but they're not right now. And the spread between December and March is showing a compressed cost to carry. I believe it is 15 and a quarter points, if my math is correct. 15 and a quarter points for cost to carry versus 18. So we're looking at 2 3/4, basically 3 points of carry. I don't know. They're selling it to you cheaper. That's basically what I'm trying to get at. Also, we're looking through the last little bits here, and September showed a green candle at the end and green candle, green volume. December showed red candle, red volume. Obviously, it would be red and red, and so did March. Without being able to see the CME change in open interest, what I would guess is that there was a lot of rolling happening right now out of September into December and March. And these last few points here that got bid up in the end of the day was basically the market makers and some of the high frequency traders front running some of this rolling and just fighting themselves. So I wouldn't view this as a structural repricing of the commodity. I would view this as market friction. Excuse me. We can see in May as well too. It had a similar jump, although not as many contracts traded at all. Only maybe 800 contracts and maybe 525 contracts for those last few minutes. But it was picking up. And then in July, it had a huge move up in price, and then even more volume at the end. So it's looking like, if I had to guess, people are buying back September, they are selling July, or they're buying back, or they're selling March and buying May, something to that effect. Now this kind of leads into what each contract does, more or less. So over the harvest cycle, September contract is where the grain elevators and the grain merchandisers are essentially fighting each other to get space and to secure storage and supply for any of the early corn that is coming off the fields right away. In the northern states, although you farmers would know this a lot better than I would, some folks can plant their crops a couple weeks early, some of them are a couple weeks later. It just depends on their personal geography. It might also depend on the type of corn they're planting, and so on and so forth. Either way though, the corn harvest kind of goes from mid-September to, let's say, mid to late October. And that September contract is really there to capture that early corn, and for the merchandisers to lock in, or maybe not merchandisers, merchants, marketers. Anyhow, the folks like Cargill, they're looking to secure space. Well, Cargill has their own grain elevators, but you know what I mean, right? Like the elevator folks and the guys buying from the elevators, or the guys buying from the elevators to ship them off to Japan or China. They're looking to secure space, and they're doing that by trading around and duking it out in September. December is full crop yield. You know, how's it all hitting the elevators, and is there any kind of logistics issues and whatever else? The March contract is full inventory, so this is going to be, you know, this is all the corn that we actually have. This is the amount of corn that's sitting in bunkers, that's sitting in elevator silos. You know, this is what we've got. And then moving out to May and July, this is more sort of macro demand and logistics. So macro demand and logistics. What's also for macro demand, we can see the relative value between the December 2026 contract, so the current harvest contract, and the December 2027 contract. The difference between those two contracts, assuming supply and demand are equal, it should just be the interest rate and inflation costs baked into those contracts. So if we're seeing an increase in December 2027 corn, that could potentially be an increase in demand from, let's say, ethanol production, or that could be an increase or a decrease, sorry, in overall expected supply. You know, maybe there's really big forecasted drought issues or something, you know, like climate change. I don't know, but you know, that can show up in those contracts. Let's look back at my notes here. Okay. So let's just review what happened here on the CME tape. So this exchange for product, or for physical, or I guess it could be product too, and then exchange for risk and transactions at the end of the day. Early on, so this is, here, I'll maximize that. This was on Monday of this week. We had a lot of movement exchanging for physical. So, you know, 17,600 contracts, 610 contracts were traded to secure corn early on in the harvest, and there was overall risk off on Monday. On Tuesday, we got 11,800 exchanged for physical early on, and then we also got some 1,100 exchange for 1,019 exchange for physical in December. That also came with that block trade where I made the mistake for my introduction video. At the end of these days, we got some massive volume coming through on the transaction trade at settlement. And that trade and settlement, those numbers are pretty close to each other. Maybe we could assume those were automatic rolls. I don't know, it's hard to say. It's just, you don't know. Also, risk off was on that day going into WASDE. We hit WASDE, change was pretty minimal overall. But what we saw was more exchange for physical in September, about the equal amount of exchange for physical in December, and transaction at settlement was fairly close, so like 15.2 to 15.9, and then open interest changes on that as well too. Then on Thursday, yesterday, when we saw that machine gun printing right at close here, if you guys recall from the last video, this is what we saw happen. we saw a huge transaction at settlements run through, 18.5 in September and basically 25 in December. That's a lot of volume. That 25 in December was basically everything that we saw hit the tape at the end of the day there. And then we saw some more exchange for physical in September, 10.3. And overall change on the day in terms of open interest was an increase of 11,600. And so that means, you know, some more risk is getting put on in there in some manner or other. Also, open interest decreased by 25,800 in September, increased by 20,271 in December. In March, it went up by 10,000. And May, it went up by basically 3,500. And July, up 2,700, pretty much. So traders are moving farther out into the curve. They're executing their roles, which makes sense at this time of year, and kind of makes sense for what is going on in the marketplace. But this exchange for physical, keep in mind, this is, you know, you've got a grain buyer that's calling up in an elevator, or you have a shipper that's calling up a grain buyer and saying, hey, I want this physical product, and they can exchange it out, and it gives like a legally contract receipt that they can use to secure space for freight or for shipping or you know, something like that, or using it to have asset-backed financing, I think, perhaps something like that. Either way, it's an important thing. It's an important mechanism. And for those of us coming from the equity space, we don't really see this exchange for physical. Like here, let's pull up ES. Like, we've got some exchange for physical and exchange for risk. But does this really mean much? I mean, in the whole concept of volume here, this is pretty minimal. 6,933 shares over. Where's the total? Over 1 million shares traded on the day. Like, that's not very much. Whereas if we look back at corn, we're looking at a total volume on the day of 1,041 or 142,000 contracts, and exchange for physical being 10,000 of them. So it's orders of magnitude larger in the commodity space. So we need to pay attention for that. In the equity space, you know, when we're dealing with the S&P 500, it's so small that it's like who cares, right? But the major players here in corn are using this exchange for physical, because corn is physical. Simple as that. And so, you know, I'm I'm learning along with you guys here. Honestly, I didn't realize I needed to be paying attention to the EFP, EFR, or TAS until yesterday evening and coming into this morning, and I was like, oh wow, this is a big blind spot. The next big blind spot, let me look back at my notes here. I'm jumping around a little bit, but yeah, the next big blind spot was really realizing what this 8-cent change in the ethanol crushing margins was. 8-cent change in ethanol crushing turns out to being roughly 22 cents per bushel, because you get 2.4 gallons per bushel, something like that. Does that make most sense? I don't know. Someone run the math for me, but it's about 22 cents per bushel here. And the ethanol refiners out there, they're running like 100 million gallons a year in ethanol. Right now, this is where they're buying all their ethanol. If they're getting a crush margin of 8 cents, that is about $8 million straight into their pocket. And to give you an idea on the ethanol demand, A lot of you farmers are going to know this. For those of us coming from the equity space, this is going to be a little mind-blowing, maybe. Maybe not. I don't know. To me, it was. We're looking at 40%. That's 40% of demand for U.S. corn is going into ethanol production. Now, this demand is required by the EPA, and they're not saying, and this is why you go to the gas station, you can see up to 10% ethanol and stuff like that. They're not saying you need to go and match your production, gallon per gallon or what have you, right? 1 gallon to 10. They're saying you need to go and produce, I think it's 15 million gallons. No, it's more than, where's the number? I don't know, could be, it's a lot. It's like they're saying you have to produce a minimum amount of ethanol every year, and then we're having a credit trading system. And so if you don't produce enough ethanol in your gasoline blend, if you're not using enough ethanol, you have to buy credits from someone that did. And that can be really expensive. So when we have an 8-cent difference, that means the ethanol producers are very huge buyers of corn in this market, especially right now. Excuse me. No, let's look at 6 month. So right now, here's 6 months of crude back in February, before the Iran war kicked off. The crude was trading around $64. When crude peaked up at 94, I don't know what the demand was from the ethanol producers, but it'd be pretty high. Right now we're sitting at, let's call it 82.5. That's still fairly high up there. But what really this means is these guys are going to be very, very strong buyers of ethanol, and unless something changes geopolitically here, they're probably going to stay strong buyers of ethanol, which is good for us. Very good for us. All right, so talked about the front futures compression here. I talked about some of the fattening tails. Just again, out in March, May and July. The spread on that is really compressing. We've got about a 7 3/4 point spread between March and May, and then only, let's call it a 2 3/4 spread between May and July. These things should be about 18 points again for your cost to carry. So they're saying, hey, we're not paying you to hold on to this corn. They really, what they're kind of signaling to the market is our logistics log jams are going to be cleared out by this time, and we don't think this corn is going to sit around. So if you're trading that far out, it may be slightly speculative, and we're going to adjust our position based on this. So stay tuned, or for the next couple more minutes here. All right, talked about the crude. All right. Okay. Now we're up to talking about our new position. So before and earlier, I was saying we're going to anchor our long call in November for the December future. I have decided we're going to take advantage of the change in contango here of how the futures curve is operating, and the decrease in the spread between December and March, now that we're down to 15 1/4 from the last print here. I'm thinking it's going to make a lot of sense to move us out into March. Now this creates some considerations. So let's look at the two. Let's look at what we've got here. Usually, if you recall from the SPX space, equity space, we want to anchor our tails somewhere in the 120 DTE range, because when we're at 120 days out, we're not paying a lot for theta burn. Okay, same deal is going to happen here. You know, options are options are options. The math is the math. The farther we go out, the less we're paying in theta burn. But the fact that we're trading different contracts, different futures that have different behaviors and different macroeconomic inputs, it's not all apples to apples. It can be apples to oranges, or in some cases, it can be like Granny Smiths and Galas. So in this aspect right here, we're looking basically at Granny Smiths to Galas, going from the December to December to March. Now, where do I want to go and price in or set this long? This makes a very, very big consideration. Now, in March, the March futures contract holds all of the grain that has actually, been collected and is marketable as the contract specifications for this grain. But being in March, it is going to be susceptible to fertilizer pricing risk, and kind of how much expected crop is going to be planted for the 2027 harvest. And it is also going to have some macroeconomic impacts and impacts from the Brazilian crop as well too. Brazil finishes out a little bit later and starts to hit the market in late December or January. So those are some things to think about. In our trade for a poor man's covered call, or even if we ran in with a zebra and we're selling against that, the big thing is we want to be able to split the contracts apart so we can capture theta decay and vega collapse. And this is important. If we end up rolling our short out to creating a vertical spread, we are not going to get the same sort of alpha that we would want, or the same kind of like expected value that we would want. It's very difficult because theta is going to burn both those contracts at the same rate, and vega is going to collapse at those contracts at roughly the same rate. I mean, there's going to be volatility smile, but it's not the sort of asymmetric play that we're wanting to do. So excuse me. So we want to look, at this stuff optimally. The other thing too is we want to go and find out where open interest is really strong, and it's really strong in the February cycle compared to the December cycle. You can see that on there. If we go to the January cycle, it is practically a ghost town. So we don't really want that. The other thing too is looking at implied volatility on the chain. It's 19.5 in December. It is 19.5 in February, but in January it's 19.8. So that means January is more expensive and it's going to be harder to trade through. So we're going to get more execution slippage, and we're going to pay more for it. We're going to pay for the pleasure of having a harder time working the order or working our position, and so we don't want that. Going out and spending a little bit more money up front in February is going to be pretty nice. The other thing too is that we're going to have a 60-day spread between the December cycle and the February cycle. So if we end up rolling our short position all the way into December, we still have a very nice poor man covered call setup that we can take and capture the December decay here. So we've got a lot of time to work in this position. It's giving us a lot of flexibility. And if we look at current pricing here for the trade, it doesn't seem so bad. A 60 delta right now is trading for, let's call that 34 and a quarter, maybe 34 and yeah, I don't know. Well, we'd probably get killed a little bit, so let's call it 34 and a quarter on entry that we can get in on. And if, for example, we wanted to do it in December, we're not saving that much, and we can't actually get the strike that we want anyways because it's not offered. It's not going up in 5s, it's going up in 10s. So we're either looking at the 65 to take more delta on than we wanted, or we're trying to get close enough to the 58, and we're going to save a little bit. It'll come out to, let's say, 27.75. Are we really going to squabble over, what is this, 4, 3, 8 points? I mean, maybe, I don't know. But to push it farther out and to have more position flexibility, I think that is worth it, especially since there's going to be a lot more volume, a lot more tradability in the February cycle compared to the December cycle. So there is the big switch. We are taking advantage of this current spread pressure that has shown up in the market. And you know what? The fact that we didn't capitalize on the dip yesterday, but it's given us time to kind of read the ground a little bit better, know what's going on, and then see that, hey, this contract spread is starting to widen out, and this is something we can take advantage of. Run a little bit carry play at the same time. So let's do that. Looking down into September. Now, if any of you guys are concerned about assignment risk, the September short is going to assign to the December contract, and that December contract can quite easily roll out into March, and us taking a stand right now in March and capturing essentially 3 points of carry is going to really help us. It's nice, it's like 3 points in the bag just for splitting our risk out like this. So why wouldn't you do it? Looking it out, 515 seems pretty decent here, and volatility on the chain is 12.5%, which is not bad. And it's let's call it 22.8 and a half, 22.8, yeah, maybe 20, yeah. No, sorry. Let's call it 22.9. 22.9 vol and roughly 19.25 vol. So that's 2.75% volatility difference between these two contracts. It's pretty decent. You know what? I think this is a good trade. I think it has a lot of potential. And keep in mind too, the 16 point spread of what we expect the carry to be. So we can assume, or the way that you want to think about it is, even though February is trading, or we're looking at the 48 in February, is this really going to be 15.5 in February? No, it's not. It's probably going to be more like 500 if we had to like just straight move it across and pick up, like if we were going to maintain this delta, or no, sorry, this strike all the way across, we're going to get that that rolling carry deficit, and we should expect it to be 18 points, but right now it's 15 points, so that would put it at 500, which would mean on the tape here at 485 we're looking at like 15 points of vertical spread if it was just moved out the way that it was. And in this whole process we're paying roughly 20 points in extrinsic value, but that's okay because we've got to pay to play a little bit. We're not going to be hit by too much theta burn, so that'll be okay. We're offsetting our theta into a higher, slower burning in the long, higher burning on the short. All you guys coming from trading SPX options, this intuitively. Some of you farmers out there, this is some quick options math for you here, right? Closer month, theta really starts to drop off in the monthly, about 45 days out, and then it drops like a rock at once you get down like 14 days or 7 days especially. But then gamma, the rate of change of your delta, how fast your deltas change or your contract value changes, because contract is essentially, it gets very explosive on this last week. So this is probably why we don't want to turn around and sell come Monday. We probably don't want to come out and sell like a 20 delta, something like that thing, because if for whatever reason the September contract decides to spike, we could be in a world of hurt, and then trying to roll out from September into December, we could face a lot of roll friction and the spread could just eat us alive. So we don't want to do that. So we're looking, just a pretty standard, thing out there. Are we going to be able to collect 4.5 points on the short? Maybe not. But we should be able to collect, maybe 2 or 3 points off of this. If we look into October. The next one, it's the 20 delta is trading for let's call that 5.5. It's not so bad. What this will do, it'll give us a kind of a feel for what we can expect on roll. So let's just go. Okay, so the credits we're going to be able to receive if we keep the same strikes, the same deltas. We can add 15 more points of intrinsic value, and we'll pick up basically about 1 point in credit. So that's not bad. But let's look at what the equal strikes are paying us so we can get an idea. For equal strike to strike, we're looking at, let's call that 3.5 points. 3.5 points per month out here right now of implied theta decay, and the IV here on the chain, 12.5 in September, 21.5 in September, and 21.7 in October. It doesn't mean that you should sell October. It just means that October is bid up a bunch right now. Could be a lot of reasons for that, but if you sell October, you're not hitting the sweet spot. Basically, that's what I'm trying to get at. You're not hitting the sweet spot. We can probably, looking at this, if we let the thing run out to expiration, as we could probably realize, if we let our September run out to expiration, we can pick up about 4.5. But we'd probably want to roll that out to October. So right now, each of these monthly rolls, we're looking to pick up about 4 points. So about 4 points is what we're looking to pick over the next 3 cycles. So we're looking to pick up 12 points on that. And that 12 points, so that's going to be September to October, October to November, and then November to December. And you know, we're expecting that. Here, I will show you just on what the because it should be about this. It should be about that. Oh, apparently it's not. the curve is changed. Sorry, that's 2 points. All this stuff is pretty dynamic. Okay, and this is another contract. So 15. Let's go up to 30. Yeah, another 2. September, October, November, December, 4 months, 8 points. I think just on the rolls or scalping, the short, if we can move in and out of the short, it could be good. Either way, what this is showing us is we can probably expect to collect 2 points per month for the next 4 months on our short. As well as having some macro tailwinds on our long. So the tailwinds are going to be this logistics pressure and this ethanol demand. So that'll be pretty nice. So again, we're looking to move our long out to the March cycle. The March futures underlie in the February cycle, and we're keeping with the standard September short. That'll get rolled into October. Now, if for instance something major happens and December futures just go through the roof, excuse me, let's see what kind of spread we can pick up. So if we wanted to try to just maximize our intrinsic value that we could pull out from this thing here, 14.7, okay, we could probably go 735. We might be able to get out of that with a small credit, but we can pick up 20 points of extrinsic value from there, which wouldn't be half bad. Let's say it keeps on rocking, okay? So we buy you back and we go out to November. Okay, we can't get a credit there. We can get a credit there. Now, do I think we can pick up another 15 points here to go to 550? Maybe. Let's assume that we can on this roll if the thing really starts to run on us. So we're at 550. And then our terminus, I don't know, you know, the end of the line here. The nice thing is we don't have to really do a lot of math to figure out what's going to be what. We just roll for a slight credit. You know, why make life harder? Harder than you have to. This is going to be a little bit different though, so it might not get there, but anyhow, good enough. Always try to roll for a small credit if you can. So that means that if we can roll this guy for a small credit here, all of a sudden we've picked up 570, and look at this, we've got 570, we've got a 485 long here, so 570, 485, 85 points of potential intrinsic value that we could get in, Plus, if we had to just keep rolling these and rolling these and rolling these, we collected about 4 points on entry. So that brings us to 89 points if, for whatever reason, corn shoots up to 570 in December. 89 points is not bad. I mean, you can have a nice steak dinner for 89 points. How realistic is 89 points going to be? Let's look. Could be a little hard. I mean, 512 is where the thing is pricing out at on that one. When that one was at 512, this one was at 524. Okay, so do I really think this thing is going to squeeze up to 570? No, not really. But I mean, this is the potential full runway that we're giving ourselves. Is if this thing just goes wild, like I'm talking wild, we could expect about 89 points. Maybe factor in some friction on exit, so maybe 80 points, something like that. Just to give you an idea on how much that is in dollars, that's $4,450 that we're gonna make out of this position if the thing just goes gangbusters. Don't assume that it's going to, but this is setting us up to do that. And the risk that we're putting on the table here to have this potential upside, okay, let's call this 29. We're putting on 1450 of potential risk, and this potential risk is if corn just, I don't know, all of a sudden demand evaporates in corn. I can't see that happening, but conceptually, let's say that it does. We're out $1,450. And that's before defending the position by rolling our short call, really aggressively here. So that is our max capital at risk, and the expected return that we could probably get out of this thing, or I wouldn't say expected return. I would say the maximum theoretical return we could pull out of this would probably be 4,450, and I mean that would be amazing if that could happen. But I mean that's not something you want to count on. I think it could be very realistic to pull 20 points out of this harvest cycle. 20 points is not bad. 20 points is about $1,000. That's roughly, what is, I don't want to do the math. 69, basically 70%. It's not bad. It's not bad at all. So we'll see if that's what we're able to get. Let's hope so. Let's look back at the notes here. Neutralizing the blind spots, theta, March anchor. Okay. So our next steps, what are we looking at over the weekend here? We're going to get some more weather data. We're going to get some more Mississippi water level data. We'll see maybe some more freight cars moving through, maybe some change with that. Who knows? Either way, the major grain houses, grain marketers, stuff like that, they're going to be repricing their risk models. Some of the commodity trading advisors or hedge funds, they're going to be changing up their models. And all that's going to be hitting the tape pretty early. We'll find out, we'll get some kind of confirmation on whether, let's pull up the chart again. That's July. Let's look at December. We're going to get some confirmation on whether there's going to be a structural repricing of corn to be around the 480 mark. And we'll see. Basically, on Thursday, we were not price takers. We were waiting for, or I was waiting for some structural triggers to hit, and the structural trigger in my mind was going to be the 100-day moving average. and I thought, you know what, let's wait till Friday if we're going to hit that 100-day moving average. We did not on a relatively light volume day, and let's reconfirm light volume. I mean, there's less overall volume than went through on that. Actually, I can let's pull up the CME. That's the wrong one. Okay, total volume on the CME was 285, and we saw 225 here. Okay, so maybe I shouldn't call it light volume, but definitely not as much volume as the day before. And so, you know, I really want to see, is this bump up, is that significant? We saw this huge rise come out to 481 after the WASDE, and we saw a pullback to 472. I was hoping for a pullback farther to maybe 465, or even 460 would have been amazing. But we may not get that. The market may be just repricing this to be what it is. And on Monday, our short call is going to enter it's going to be 40 days to expiry, and so it's going to start, you know, running into that that rapid theta burn window. And so, you know, at a certain point, we have to just, you know, plant our flag. And there is no better time to plant our flag than when we know quantitatively we're hitting some of our optimization numbers, or we're running up to that final window. So, you know, I don't want to give up 2, 3, 4 days of theta just so I can try to get a good long entry. That's not what I'm trying to do. And if the market falls back on me, then I can always buy back that short and roll it down, you know, sell at a lower point, something like that. Like, we've got a lot of room to work with here, and a lot of time, a lot of theta to work with here. Basically today, the market didn't move the way that we hoped, but it opened up the visibility for some opportunities and gave some time for some more research and more understanding on just how corn operates. Keep in mind, this is only my second corn harvest, so some of this stuff I am learning, and you're learning along with me, potentially. You know, some of the stuff you guys might already know. Anyhow, corn is moving up. We're gonna go wait and see if this move stabilizes on Monday, if it sells off. If it decides to just start crunching higher, what does that mean? That probably means that after an hour or so of open, so probably around 9:30, you know, we can't look at this just because it dipped here at 9:30 being our entry, but we're probably going to enter in some of these lower volume times, and it'll just be a lot of tape watching to see, you know, does it look like it's trending down, roughly speaking, at this moment, and should we capture it? If we manage to get a good entry, you know, we might improve our positioning by 1 point. Also, though, when we get our position in, we want to hit in our short. So the short might not be pricing as nicely as it could have been. So our net change or our overall position may not change very dramatically, which is why you don't need to really micromanage this. You know, perfect is the enemy of good, and good is good enough. So here's where we are. We'll see where we end up with on Monday, but expect a live action entry on Monday. So thank you guys for sitting around. This was a bit of a longer video here. We're sitting at just about 59 minutes, but thank you for joining me, and I hope to see you again, and happy trading. Bye-bye.